I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk to you. Interesting time since we last spoke. The market popped up a little bit, but today, of course, it took a little bit of a hit.
Yes, and we're wondering, is it news of the world or people just very nervous when it comes to stocks?
Well, there's two things happening. First of all, the news I'll talk about for a minute, and that is, there's all kinds of news every single day, but one story kind of buried in today's headlines, and we got the China negotiations with Trump, and the Trump administration is now delaying a meeting that was going to happen this week. And this is one reason the market's dropped. Johnson & Johnson gave a negative sales forecast. Black & Decker did the same thing. In fact, this quarterly earnings season started really last week, and earnings have been a mixed bag. And there have been several companies that have downgraded their estimates for the rest of this year. But the market is kind of, relatively speaking, held in there, and I'll return to the stock market in a minute. But the one story I think is important, and is probably getting lost in the shuffle, is that the IMF downgraded its global estimates for economic growth around the world. And China actually did the same thing. And we've been talking for quite some time, regularly. And last year, around June, we brought up the fact that the global yield curve inverted, meaning that around the world in the global bond market, the short-term rates got higher than the longer-term rates, which is the most accurate predictor, forecaster of a coming slowdown in the economy and even a recession. And it predicts it 6 to 12 months out. So I think this news from the IMF and from China is a confirmation of what we saw coming 6 to 12 back in June is now beginning around the world. Now, this was an economic indicator for the whole world, not for the United States. In the United States, the bond market didn't give that type of signal until the start of last year. So I think this is the big fundamental picture that we're actually looking at for this year is a slowdown in the global economy just starting and probably will carry over into the U.S. economy. And I take these earnings news as a sign of that. It doesn't mean the U.S. economy is going to get into a recession next week or next month. But the fact of the matter is we're at the top of the economic cycle, and the thing is the Federal Reserve has been raising interest rates over the past couple of years, but it's now putting out all the messages that it's going to pause those rate hikes, and they're coming to an end, which is a sign that we're at the top of the cycle. And the last two times we're at the top of the economic cycle was 2007 and 2000, and you had big bear markets. Now, we saw the stock market drop 20%, the S&P 500, from the end of September to December. And since the day after Christmas, we've had a pretty big rally, a straight up move, which has taken back over 50% of the losses. And that action has been the focus of stock market investors and people who like to trade, who like to buy, people fully invested in the stock market who want the stocks to go up. But I look at the market as having two time frames. One is the big picture, which we're at the top of the cycle. We had a 20% drop. We're below the 150 and 200-day moving averages on all three major stock market averages. 70% of the stocks in the United States are below those moving averages. That's my definition of a bear market. And in a bear market, you do get counter trend rallies, and they tend to be very sharp. The gains all come within 2 or 3 weeks, and then you'll typically see the market drift for several weeks before it really starts another decline. So that's the shorter term outlook. It's what is the daily action within the long-term trend. And I see the long-term trend is now down, but we've had this rally, and that's what everyone focuses on. And those bear market rallies, they tend to just top out one day, and it's very difficult to predict when that day comes. And then you see sideways action for several weeks. So it's possible we top Friday, but I don't know. We could go up a little more. We could see the S&P 500 go up to 2750. I really don't have a way to predict the exact top ahead of time, but when it does come, or if it did come even, what I would expect to see is the stock market to simply go sideways for several weeks before it begins a real substantial decline. So today, that market went down, and I know that can scare people too. When you have a big down day, at one point the Dow was down over 400 points, but I don't think we're at the point of a significant decline like we saw the last 3 months of last year yet. More likely we'll see, this market drop of today, get a little bit of a footing and will, go sideways or even go a little bit higher. So that's the outlook I have right now, that, we're probably not going to see that much meaningful action in the financial markets, for the next couple of weeks, but we've got to be on guard, probably starting in February and hopefully not until March for the next significant decline, to begin. But there's pockets of strength, and for people who want to buy, that's what they should focus on, in my opinion.
We'll have more with Mike Swanson when we come back.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Just before the break, Mike, you were mentioning pockets of strength. What are those pockets?
Well, there's just a couple. Even though, here in the United States, everyone trades Apple, Nvidia, the FANG stocks is all they talk about on CNBC. And I believe the reason for that is because that's what the viewers all own, and they like to hear people's opinions on them. But since the beginning of September, there have been a few sectors that have been able to go up, and are up higher from where they were, in September as the stock market fell. And even today as we're speaking, in which the Dow at one point was down over 400 points, there are a few things that were up. And the primary place to look for that is gold, silver, and the mining stocks as a whole. The GDX ETF, which for disclosure purposes, I'll say I own a position in, it was actually up today. And the GDX ETF is at, I'm trying to load it up as we're speaking, but it's at $20.45. And in September, it was below $18 at the end of that month. So that's a pretty good return of 15%, while the stock market, is still down, from where it was at that same time frame. And the reality is, when you're at the end of an economic cycle and people, you can tell the Fed's either going to stop raising interest rates or even be lowering them before the year's over. If there's softness in the economy and the stock market drops again, the primary beneficiary of that is going to be gold, because it's going to cause the U.S. dollar to weaken. And that's the same sort of thing that happened in the last two cycles. Gold outperformed the Dow and the S&P 500 from the fall of 2002 to the end of that bear market in 2003, and actually continued to outperform all the way beyond 2008. So I think at this moment, gold is, if people want to buy stuff, that's the place to be looking. And I really honestly don't have a way to trade and make money playing Apple and the popular stocks, because you really got to jump in and out of them and day trade them at this point, because the trends are very difficult. You're not buying something that's going up on a monthly basis. Whereas with GDX, it's actually gone up every single month since it bottomed in September. So that's where I'm interested in putting my money to work this year. And the thing about gold in commodities, they tend to have a cycle in which gold and silver go up first, and then other commodities follow. So I'm actually, dipping my toe into buying some of the agriculture commodities, even though they're not yet breaking out as bullish as gold. GDX, for example, is above its 150-day moving average, right below its 200-day moving average, which is at 2056, whereas GDX is at 2045. Whereas we were talking before, 70% of the stocks in the stock market are below those moving averages. Mining stocks are above them. And as a rule of thumb, that moving average tells you what the long-term trend is, and you want to buy stuff above it, generally speaking, and avoid things trading below it unless they look like they're in a position to break above them. And I think that's where most commodities are, the soft commodities. They're below the moving averages or near them, and they have the potential to break above them this year to start new bull markets, whereas the U.S. stock market just fell below those moving averages a couple months ago, and we're just getting a rally back up to them. So it's a bear market rally. And that's how I think people need to think of things. And as Jim Cramer says, I don't agree with everything he says, but there are some things he says that are really worth paying attention to. He says there's a new bull market somewhere. Well, where are those new bull markets at? They're not in Apple, which had been going up for years. So what's new? And I think the news story this year is going to be gold and silver and the mining stocks. So I know that might be old hat to some listeners of your show, because a lot of your guests specialize in that, and that's great, because it gives us people really knowledgeable about that sector. I'm not as knowledgeable as many of your guests are on specific mining stocks and even the sector as a whole. I'm more of a big picture macro guy, and now I'm telling you, the macro picture is telling me your guests are going to be the best experts to listen to over the next couple of years for sure.
We'll have more with Mike Swanson right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, do you think Apple is really going to regret buying back so much of its stock? And will a lot of companies that did massive stock buybacks regret doing so?
Well, it's a funny thing of Apple because it's actually down year to date, even though it's announcing all these buybacks and so forth. I don't think the management regrets it because what they do is they use the buybacks to boost the share prices to levels they wouldn't be otherwise, and they sell their own shares. So the Apple CEO, he's got a regular sell program in which he's liquidating, and he's in effect using buybacks to keep the stock up higher than it would otherwise be. And Facebook is the same way. Facebook, even though it's been falling since September, it'd be falling more if it wasn't for the share buybacks. And Zuckerberg is selling and selling. He sold billions of dollars worth. I don't have the exact amount off the top of my head, but at least $1 billion worth of stock. It's an amazing amount of money. I think it was 2. But corporate America, that's what they do. They sell. The companies that will regret it are going to be the ones that are on shaky financial conditions. They have a lot of debt. They've taken on a lot of debt to do these type of share buybacks. Apple and Facebook aren't in that situation, but companies such as Caesars, the casino gambling company, they're a heavily indebted company. And last year they announced all these buyback boost programs, and the management teams used them to sell stock too. But that's a company that's got so much debt on its balance sheet that I fear it's a good chance it'll end up going bankrupt in the next couple of years. And there's a lot of companies like that in corporate America. And I think that will actually become a problem for our corporate debt market and so forth. Although I've seen rapid rally in junk bonds. The J&K ETF went from 33, where it bottomed in December, up to 35, which is a wild move for that in just the past couple of weeks. But if it tops out here and goes below 33 before this year's over, it's going to be telling us that the big problem is going to start to appear in the debt markets from these companies borrowing so much money to use that money to finance crazy stock buybacks so they could sell shares, and these people will be gone. You know, if Caesars goes bankrupt, the CEO and the board members that have made millions of dollars by doing this, you know, they're not going to care. The shareholders who don't sell think these are good investments and just ride this stuff out. They're the ones that are going to get burnt, and the people that own the bonds are going to get burnt. But I'm just using Caesars as an example. There's hundreds of companies that are doing this. I just mentioned one, so one company can get mad at me. If I mention dozens, then I got dozens of companies mad.
Mike, thank you so much for chatting with us.
Thank you. Good to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.